Thank you so much, Dr. Anita, in joining us in this series or episode 1 of the podcast series which Prospera Capital is bringing out. As the economic advisor to the entity, we are bringing out this series purely from a knowledge dissemination perspective for our clients and investors. So without much ado, let me move directly to the first topic of discussion. So if I say the statement that financial markets are a direct reflection of the underlying economy, would that be fair to say so?
So, Bijoy, it would be fair but not complete, because markets are a combination of 4 different factors. The state of the economy, not as it now, but the state of the economy as it will be in future. So markets' expectation of what the GDP growth would be or how the economy will behave. It's the future expectation. Yeah.
Right.
The second factor affecting it is the expectation of how the regulators and the policyholders will react to that future economic situation. So policyholders' reaction. So, for example, if you talk about the US economy, if the economy is likely to grow, then where the inflation would be and how the Fed would react to that inflation target.
Right.
Future economic expectation, future policy reaction to that, plus the currency strength, because the money flows in different directions. Then an investor may want to place money where the valuation is. If the Chinese equities are cheaper or if the Indian equities are cheaper, they will shift the money there regardless of what is happening in the US. Right. So the US market has to take into consideration the technical factors of demand, supply, and where the money is moving. And the fourth is the strength of the currency.
Right.
Because that also does affect overall flow of funds. So overall, a combination of these 4 factors is what decides where the market would be at any given point of time.
Understood, Doctor. So we as investment professionals and our clients mostly being professional investors and informed investors, so to say, there's always this one key indicator which we look at in terms of deciding on our investment views and our investment decisions, which is the 10-year treasury yield. From the perspective of the way in which market is today, the dynamics in play, the new dispensation in US, the changes in geopolitical factors, if I may ask you, what would potentially be the trajectory? Let's stick on to 10-year yield alone. What would be the trajectory which we can potentially look at?
Now, Bijoy, this is a very big question.
True.
Right?
True.
Because 10-year yields get impacted by a plethora of different factors. So let's say if we look at one by one, what is the current benchmark rate is the key thing that affects where the 10-year would be, right?
Right.
If the current benchmark rate is being cut or being raised, that affects the 10-year stand.
True.
So if you're saying it's at 4.5%, investors would need to understand where the inflation target for the US economy is between now and the 10 years, and in that space, how the benchmark rate would move. Right. My current personal expectation is it's going to be, if the short term current rates are at 4.25, I would expect a notch or 2 25 basis point cuts in the next within 6 months to 1 year.
Right.
So if we expect base rate as 3.75, let's say, the 10-year will not necessarily reflect the same magnitude of the move. The 10-year may just move 10, 15 basis points.
Right.
Yeah?
Right.
The second point to consider is the national debt in the US.
Correct.
There are a lot of concerns about the rising national debt.
Correct.
US currently, the debt to GDP is already at roughly 100%. The way the tax cuts are being announced, the changes to the fiscal policy, the continuing expenditure, the chances are US's national debt is projected to hit 125% of GDP, which will impact the credit rating, which will impact the premium that the market wants on the US debt.
True.
Right? So if the market wants higher premium on the US debt, then that means yields will be higher. Right? So one point we talked about, the benchmark side might bring it down, but the increasing national debt and increasing risk in the US paper will take the yields up.
Correct.
Right?
Yeah.
Then the next point comes in terms of rest of the world's perception and the technical flow. The demand for US paper, US assets is slowly receding. The de-dollarization that's happening around the world, it is slow, but it's there. So there are competing different currencies in different markets where the money is flowing, particularly with a lot of managers increasing their asset allocation to emerging markets.
Right.
Yeah?
Right.
What does that translate into? That translates into higher premium that the investor would want on the US. So that's a thing that will take the yields up a little.
Correct.
Yeah?
Yeah.
Then there could be very many disruptive policies, the tariff talk and some kind of another, US, the Trump administration may announce other disrupting policies.
Right.
That would have its own impact on the yields.
Correct.
Plus the knee-jerk reactions that generally market shows. So putting all those things put together, I would expect US 10-year yields to remain range-bound in the next 6 months to 12 months and fluctuate between a 4% to 5% band.
Okay.
I'll be very surprised if it falls below 4, and I'll be surprised if it rises above 5. That's my current take on it.
Now, that's quite reassuring for many of our clients who have potentially taken certain positions based on the indicative levels of 10-year yield as a single point of reference. Typically, investors tend to take 10-year yield as one of the key point of reference in making their decisions. So thank you so much for that input. Next one is probably more like a much more broader or a generic question. For a client who is venturing out in the market today, no, I won't say that venturing out for the first time, even for a seasoned investor who has remained invested in the market for a very long period of time, from a hedging perspective, considering all the nuances and variables going on around, what could be probably the top 2 or 3 hedging strategies which he or she should adopt?
Hedging strategies, Bijoy, hedging strategies are different for different products,
Right.
different for different markets,
Right.
Because quite often you may want to put a very technically advanced hedging strategy, but you may not be able to implement it depending on the liquidity in the market.
Right.
So I'll stay away from making very specific, product-specific hedging strategies.
More on the broader side.
As a broader question, I think to me, the best hedging strategy is to have a portfolio which is very well diversified across different asset classes and in consideration of your investment horizon. Right? So investors should be revisiting their asset allocation at least on an annual basis. To me, that's the best hedge against erratic volatility in your portfolio.
Understood.
Yeah? The second thing I suggest, and in fact, request investors is to be a little slow to react. Unless you are a day trader, unless you are an algo trader using some kind of algorithm which is using the tactical data points to make your trading decisions.
True.
If you are a fundamental value-driven investors, then I strongly suggest to be slow to react to some of the headline announcements. Yeah?
Right.
Particularly now, because the Trump administration is known to make very chaotic announcements.
Right.
But at the same time, Trump does wind back a lot of, his initial headline announcements and then temper them down to what looks like a more reasonable situation, those things.
Right.
So if an investor was to suddenly react to the announcements, you tend to lose out on the alpha that you may have otherwise generated in the market. To sum it, as a generalized hedging, diversify your portfolio and be slow to react to headline news, is what
Understood.
I would say. Yeah.
So again, from a US versus emerging market perspective, even our own in-house view to a great extent is, the so-called weakening of USD as a currency is going to prevail for a certain period of time. So from that perspective, do you think that opportunities in emerging market should be looked at more as part of the major investment objectives of the clients today?
Definitely, Bijoy.
Right.
Definitely. Emerging markets, allocation to emerging markets have been increasing in the last 2 decades, actually. It's going slower than what I anticipated. Because if you look at the current GDP contribution from emerging markets, it's almost 50%. Yeah? But if you look at the asset allocation to emerging markets, it's still less than 50%, depending on which asset class you're looking at, right? So if we talk about the debt side of it, the debt allocation to emerging market debt is reasonably, it's still hovering around 35% kind of. So there is room there to allocate more to EM debt. Not just on the basis of diversifying and reflecting the underlying global economy, but also from the perspective of the currencies in the emerging markets are strengthening. The markets in the EM side are getting deeper and deeper and deeper. There is more opportunity to do stock selections because in the EM pool, you have from B- rated entities to A+, AA+ kind of entities. So it's a very heterogeneous pool that allows you to select according to your strategy. Right? So it's a deeper market. It's a deeper market. And it gives you higher carry at the moment with less volatility because of what the Trump administration is doing, kind of thing. The US assets are gradually losing their luster, mildly so, but nevertheless, the trend is there. So I'm a big fan of rotating into EM debt at the moment. Yeah.
Right. So, I mean, if we can focus a little bit more on the favorite space of yours, which is fixed income, whether it's on the corporate debt or on the sovereign side, if I may ask you broadly, what could potentially be termed as the promising sectors today within the fixed income space where an investor should or rather broadly focus on?
So before jumping into the sector space, Bijoy, I think I would like to highlight a little bit about the regional space.
Absolutely.
Yeah, because if you know, in the fixed income space, the biggest sector is the government sector. Right. Yeah? 50-60% is government paper, then 30-40% is bank paper. So the sector diversification of the broader market is not as much there as when you say sovereign sector, which is sovereign. So the region factor comes in the picture. In that regard, in the regional space, I'm a big fan of the GCC market.
Understood.
Yeah. GCC bond market, if you know, I'm sure it was your point that
indeed.
You were saying it's now more than 1 trillion.
More than 1 trillion, correct.
And I remember in 2014, when I started covering the Middle Eastern market, the total outstanding was 176 billion.
Right.
So it's grown 5-folds in 10 years.
True.
It's the fastest that I have seen of any market. In the emerging market bond index, GCC today is 22% of the entire emerging market bond index. So it's a huge segment in there, but it's also one of the most resilient ones.
Very true. Very true. Yeah.
Like if you recently, when all these Trump policies and when the bulls and the bears, everybody was hurting, market was not forgiving to anybody. Even in that time span of last 4-5 months, GCC bonds were very resilient.
Right.
The movement was not much there, and partly because this is what you call the capital of the capital region.
Correct.
There's a lot of money here.
Right.
The credit ratings are solid and stable in AA+, single A+ kind of range. The demand supply dynamic wise, the supply is still far less than what you see in the developed markets.
Right.
And the currencies are pegged. So it's dollar based kind of thing. And you have the sukuk element also. So buy and hold kind of investors who hold sukuk also tend to hold the conventional bonds when they buy.
Right.
So all these factors put together makes GCC one of the safe haven bids within the emerging market space.
True.
Yeah. So GCC has done reasonably well and pays reasonably well for the kind of risk it has, and now the liquidity has improved substantially.
Correct. Yeah.
Moving on to your question about the sector that you asked. Yeah. Sector-wise, normally there is reasonable case for investing in the corporate space because you get to take bigger carry home. Your return is a little bit higher if you understand the credit properly.
Right.
But in the Middle East, not just in the Middle East, in the emerging markets actually, the government papers also gives you reasonable carry over the developed markets government paper.
Right.
Like here, for example, a Saudi Arabian 5-year paper will still give you 4.7, 4.8% yield versus a 4.1, 4% or 4.1 on the US Treasury. So the 70-80 basis point pickup is already there.
Correct.
Yeah?
Yeah.
But you get reasonably good clarity, disclosures, and the backing of the governments there. So I prefer the sovereigns quite a lot in the emerging markets.
Sure.
But to get an extra bit of carry, the GREs, the government-related entities,
Right.
which are corporatized, institutionalized corporates, but have the government backing and government ownership,
Right.
allow you to pick up additional 50-60 basis points.
Right. Okay.
So maybe instead of, let's say, a Saudi government, you could pick up a PIF,
Right.
or an Abu Dhabi government, you could pick up an ADNOC or Mubadala or something like that.
Right.
Yeah?
Right.
Then in the banking space, because banks also make a big segment of the fixed income market,
True.
I like the tier 1 papers.
Right.
And it's because the banks here are reasonably well capitalized. So the tier 1, there is not much risk of you losing the tier 1 paper or tier 1 paper getting converted into equity.
Right.
But it gives you a coupon over 6-ish%. I mean, most tier 1 papers would be 5.5 to 7-8%. So it's a reasonable good carry trade with the managed risk there. So in the banking space, I like the tier 1 paper. Corporates, it's going to be case by case by case. It depends which corporate you're checking and if the value is in light with risk reward profile matches or no.
Right.
So that's where I'll stop on this. Yeah.
No, absolutely. That's a major input, because what we have observed is in most of the globally diversified portfolios which most of the clients are holding, there is still a major underrepresentation of the region, whereby the region is actually offering you a lot of alpha, as you rightly mentioned. So we are trying to keep the interaction as abridged and summarized and short as possible. So we can probably draw the curtain on this interaction by asking one simple final closing statement from you. For a new investor venturing into the global markets, again, it's a broader question, but we can probably try and give a simplified answer. What should he or she look at from a simple portfolio allocation strategy basis? What should be the allocation they should look at, considering all the apprehensions around the market today?
Okay. So I can tell you where I would put my money.
Right.
Because
that's
this
the
is
right
not
one.
a recommendation to any
Very
investor
true.
for any
Absolutely
kind
not.
of, Prospera is not recommending a standard.
Absolutely not. These are all for knowledge purposes alone, nothing else.
Exactly. If I have $100 today, where will I put my money in it?
Right.
And I'm a experienced person about the market, but at the same time conservative. Looking at my age, obviously I want to preserve my capital, so keeping capital preservation in mind, but still somebody who understands the market. So that's the background. Where would I put my $100? I think I'll go 50 in debt.
Right.
In that debt, I'll go 30 to developed markets, 20 to EM.
Right.
And I know I talked a lot about in favor of emerging market debt. So you may ask, why am I saying 20 to EM and 30 to DM at the moment? It's partly reflective of, in the DM space, there is scope to make money on technical grounds at the moment. Because of the volatility that has recently been created, might allow us to get an alpha in the next 6 months. So 30% DM debt, 20% EM debt. Of that 20 EM, I would go 10 to 15% in dollar-denominated EM debt, and maybe 5-6% in emerging market currency-denominated EM debt.
Okay.
Yeah.
Okay.
Equities, I'll keep it about, say, 40%.
Okay.
And in that 40%, currently, I actually, on the valuation basis, I'm a little skeptical about US. The US S&P 500 is already over 23 times PE ratio versus, let's say, China, which is only 10, 11 times PE ratio.
Almost half of that, yeah.
Yeah, Europe and UK are somewhere around 17, 18.
Right.
So purely on valuation basis and purely on the ongoing global theme of de-dollarization or, losing luster for the US assets, I'll go a balanced approach. So my 40% equity allocation, I'll probably go 15 to US, Europe, China.
Okay. All
Yeah,
right.
and the 5 maybe other EM.
Right.
So that takes me 50 debt, 40 equity. The remainder 10 is what I call play money. In that play money, I will definitely look at the crypto. It's an upcoming product that it's not regularized. Trust may be an issue in the product, and it's very, very volatile roller coaster. But at the same time, I'm a firm believer that humanity follows innovation.
Right.
And crypto is right now may or may not be understood very well, may or may not be regulated very well, but it does seem to have value as a universal currency. So I will play into crypto a bit.
Right.
And then just to stabilize everything, I'll keep a little bit cash on the side, 2% cash on the side, and maybe 3-4% on gold.
All right. So that's a fairly straightforward and easy to understand portfolio allocation for the beginner, so to say. So, thank you so much, Dr. Anita. It has been a wonderful interaction, short, abridged. So we look forward to more interactions in the coming days, in the coming months with you. So we would like to give, as an entity, as from Prospera Capital, as a group, we would like to give small snippets of information like this for our clients, from which they can potentially take some cues. As you rightly mentioned, none of these are recommendations, of course. These are more like cues on which you can depend on to decide or make your investment decisions. Once again, thank you so much, Dr. Anita. It was wonderful interacting with you.
Thank you, Bijoy. Thank you very much for having me. And to our dear audience and investors, we would like them to send us questions as and when they want to anything that they wish to know, to either as part of this podcast or to the Prospera website.
Absolutely. Thank you so much, Dr. Anita.
Pleasure.
Thanks a lot.
Pleasure.
Thank you.